in 2014 when you prepare your tax return. So that's what a lot of tax planning is about. We can't do it all the time, but there are several situations that come up where we can, this is a good example, make a decision as to what's more advantageous for us. Should we take the deduction in 2013 or should we defer it? Should we capitalize it? The next item talks about determining your personal tax rate. Now that is something I think that a lot of business owners really don't understand, and they really need to work with their tax advisor to know, what is your tax rate? What is your tax rate in 2013? What is your tax rate in 2014? What do you think it's going to be in the future? I've got an example down there, and this is kind of shocking, I think, for a lot of individuals. If your taxable income when you're married is $100,000, what is your tax bracket? Now, I'm talking about business owners that file. Typically, most business owners are Schedule C proprietorships. And so they pay Social Security taxes on their profit from their business. So if your income is $100,000 of taxable income, the 25% federal tax bracket is on, you can see that on page 3 of the guide. Okay, if you go to page 3 of the guide, it'll show you in the first section there, married filing joint. And you'll see that if your taxable income is between $72,500 and $146,000, you're in a 25% tax bracket. Any income earned in that range is taxed at 25%. So if your taxable income is $100,000, potentially if you take deductions and try to reduce your income from $100,000 down to $70,000, you're going to save 25% in federal taxes. But that's only part of the equation. If you're a business owner and you're Schedule C proprietorship, you're going to pay state taxes at 6% in Kentucky. Ohio is a little bit less, but you get some deductions, but it's basically about the same. And you have, if you're in a city like City of Cincinnati, City of Covington, City of Newport, there's a 2% tax rate on your profit. And then you have Social Security, Medicare taxes. It's right around 15%. A business owner who has made between $70,000 and $100,000 of income is paying taxes at 48% on their profit. You know, whoa. And for a single taxpayer, that's why I cut it in half to $50,000. If you go down to the table here, page 3, it talks about the 25% bracket is from $36,000 to $87,000. So if you have $50,000 of income for a sole proprietor, a business owner, and they're single, okay, you're going to basically be in the same situation with the 48% bracket. And you don't get to a 15% bracket if you're married unless you're way down, below $70,000, $72,000 of income if you're married. Or if you're single, it's got to be it's cut in half, $36,000. So you can see how taxes are pretty significant, because even if you're in a 15% federal tax bracket, your overall taxes are still almost 40%. At least a third, maybe, if you don't have any city taxes. Why is this important? Well, you need to know where you are to do any planning. You need to know what your tax rates are. And if you're optimistic as an entrepreneur and business owner and expect the future to be brighter and bigger, your taxes are only going to go up. Yeah, that's right. To put it in perspective, I had a lady that's a beautician that's single, no deductions and everything, and she was going to make $60,000 as a single person. All of her taxes added up to $20,000. She was going to pay 1/3 of her income. And that's what I find usually, without doing much of any computations at all. Most people are in at least a 1/3 bracket if they're self-employed. And even individuals, when you put in your Social Security taxes, your income taxes, and your state city taxes, and even as an employee, you pay 1/2 of your Social Security taxes, you're in a 25% tax bracket. So to me, what's important with that, knowing that, is that to me it should incentivize you to do everything you can to minimize your tax liability. And how do you reduce your tax liability? Well, you're not going to cheat on your income. You got to report all your income. But there are some methods we can use for business owners, if you're cash basis, to try to defer income from one year to the next. And also what we want to do is we want to try to maximize your deductions. That's what it's all about, is maximizing your deductions, because if you do maximize your car expense, if you do maximize your travel expense, if you maximize your business expenses, then you can see the money that you're saving. $10,000 of deductions for a business owner could save them almost $5,000 in taxes. That is substantial. Okay? What I'm going to also mention is we got note cards out here. So as we go through the program this morning, if you have any questions you want me to address, we're going to save some time at the end of each hour to answer questions on tax planning. Write it down, just hold it up, and Carrie, Scott, or someone will pick it up, and then they'll give me the questions at the end of the hour that we save some time for, and we'll answer those questions if we can. The other thing that we talked about when we promoted the seminar is that each of you are entitled to a 1-hour free consultation with me. So after this program, this is a workshop. This is intended for you to say, gee, what questions do I have? You may want to meet with your attorney. You may want to meet with your CPA. You want to meet with your financial planner. And after you meet with them, you may want to get a second opinion with me. Because I am an attorney, I am a CPA, and as a CPA, I'm called a personal financial specialist. It's a CPA that specializes in financial planning. I was one of the first 400 CPAs in the country that got certified back in 1988. Today in Cincinnati, there's only 50 CPAs in a 50-mile radius of Cincinnati that are CPA PFS. So it's a very elite designation that I earned a long time ago, and take great pride in that, because as a tax partner at Touche Ross and Deloitte & Touche, I work with business owners and individuals in their financial planning, and that was one of the things I specialized in when I was at Touche Ross and Deloitte, was financial planning for the business owners, tax planning for the business owners. And so that's what all this kind of comes. You'll see a lot of the blend and the focus in the seminar is going to identify what business owners can do to reduce their tax liability. So if we go on to the next page, there's some other taxes that are there now because of the new Healthcare Reform Act. And again, they're indexed on, they're referred to by page 5 and page 12. But there's also a tax, the Medicare surtax on net investment income. If your income is over $200,000 single or $250,000 joint, and you have net investment income, then it potentially is subject to an additional tax of 3.8%. In addition, if you have earned income in excess of $200,000, $250,000, there's a 0.9% surtax on your earned income when you reach those thresholds. So there's also another special rule that applies if you're in the highest tax bracket. And on the tax guide here, you'll see that the 39.6% rate for married couples kicks in if your income is over $450,000. I have a client that is selling their business, and their income is going to be, significantly over that amount, and their capital gain in 2014 is going to be 20%, not 15%. Okay. And there's a special rule that applies for business owners who materially participate in the business, that while they may be subject to a higher capital gain rate, they're going to avoid the tax on the net investment income because they materially participate in the business. So if you're a business owner, like in their situation, they're selling their business, they materially participate in the business, the gain on the sale of their business is not subject to the tax on net investment income because they materially participate. And you say, well, what's materially participate mean? That's at the bottom of page number 5, one of the common safe harbor rules that we use. This is on the second page, item number 5, is that you work 500 hours a year, 10 hours a week, 50 weeks during the year. And if you do that, and we're going through IRS audit on this, you need to document your activities. If you're trying to defend this, and I'm going to be emphasizing that throughout the program on taxes, documentation is the key. You have good documentation, we can breeze through an IRS audit, and it happens all the time. You don't have documentation, and you've got a problem. I can guarantee it. If you don't have the receipt, they disallow the deduction in audit. If you have your documentation, no problem. Moving on page 3, the next page, there's also the alternative minimum tax. This is important because a lot of individuals and couples that are in the $100,000 to $300,000 taxable income range are subject to alternative minimum tax. It's a separate tax computation, but the reason that the reason it kicks in is typically because they pay a lot of taxes, but that's important to know because your income may fluctuate and you may want to do some alternative minimum tax planning. I'm not here to explain all the rules to you. I think it's important to ask the right question to your tax advisor. So you should be talking to your tax advisor. Am I facing alternative minimum tax, and is there any planning that I should be doing? I think it's something I found out over the past 40 years I've been practicing as a CPA. The big advantage that helps me as a CPA is I'm also an attorney. I know what questions to ask. And that's what's important. If you ask the right questions, you can always find out an answer. But if you don't ask the right questions, you'll never get to the answers. Okay? The next area would be choice of entity tax planning, because I mentioned a sole proprietorship. If you are a business owner and you are a sole proprietorship, you can elect for 2014 to be an S corporation. You have until March 15th to make that election for 2014. You can't do anything about 2013. And you may ask, well, why, as a business owner, would I want to elect S corporation? And I kind of got it figured out this way. The advantage of being an S corporation is that you only have to pay yourself a reasonable salary. And if your business is more than just a job, then your income that you're generating in the business is more than what you would pay yourself to replace yourself in the business, whatever your level. Then your business has profits that you're paying Social Security tax on. If you're a business owner, it's really important because the Social Security tax base is up to $120,000. In other words, if you're a Schedule C sole proprietorship, you operate, a hair salon, or you have people working for you, you have employees working for you, you have a business, you do manufacturing, you sell jewelry, whatever the business is, that business has a profit, and the Social Security taxes, if you're just the sole proprietorship, you're going to pay 15% on the whole shebang. And it really is important for business owners that are in this, that your compensation should not be $100,000 or $120,000 because you don't really save much in taxes. But if you could say you justify your compensation should be around $50,000, $60,000, a reasonable number for the nature of your business, then if you could have your income taxed only $60,000 being subject to Social Security tax, and the other $60,000 be dividends from an S corporation, you distribute your profits when you elect S corporation, your profits are not subject to Social Security tax, then you're talking about 15% of $60,000. You're saving $9,000 in Social Security taxes. Now, when I do this planning, I try to caution clients, your Social Security benefit when you retire will only be based upon $60,000. You're not going to get the max. Depends on your age. The thing you need to know, though, is Social Security is based upon a 40-year average. So I have businesses that are starting up, and I'm saying now's when you need the cash flow. Now's when you need to save taxes. I'm okay that you go light on your Social Security for 2 or 3 years. You can make it up down the road. I also recommend that if you do this type of planning, that you use that money you save in taxes and put it into an IRA. So it supplements your Social Security benefit when you retire. So you're not robbing Peter to pay Paul. You're saving taxes, but you're doing the prudent thing from a financial planning perspective, in that you're putting the money away that you're saving in taxes into a retirement plan. So that when you do retire, you're going to have hopefully this extra money accumulating down the road, in addition to your Social Security benefit, that will be reduced. There's a good outline, and I'm not going to go through it, on pages basically 7, 8, and 9, that talks about the different types of entities that you can choose, whether you should be a sole proprietorship, a partnership, a C corporation, or an S corporation. It's a whole hour seminar just in itself on just that topic itself. There also is an LLC. What you need to know is that a lot of people are setting themselves up as limited liability companies. And a lot of people don't understand you're either member managed or you're manager managed. There's special rules on that affect Social Security taxes. There's also special rules that say, do you want to be, a partnership? You can make an election as an LLC. The LLC is not a tax entity. If you're one owner LLC, you're a sole proprietorship. If there's 2 people, you're a partnership. But you can make an election to be taxed as either a C corporation or an S corporation. You should be talking to your tax advisor and say, explain to me, why am I the entity that I am? And should I make a change to an S corporation? Or if you are an S corporation, you might want to raise the question, should you really be an S corporation? I have clients that are S corporations that go, why are you an S corporation? So that's something we can talk about if you want to do a follow-up consultation with me. Okay? The next item is retirement plan options. Bottom page 3. And really, a retirement plan, I learned this 40 years ago. First year out of college, is like, man, the best tax shelter is a retirement plan, whether it's an IRA, a 401k. There's all kinds of pension plans, defined benefit pension plans, money purchase pension plans, profit sharing plans. There's all kinds of plans out there. Again, the important thing, when you look at the bottom of the page, I've identified that an IRA, you're looking at $5,500. And if you're over 50, another $1,000, you can put $6,500 into an IRA. If you're over 50 or older. You may want to do a simple IRA, or you may want to do a 401k. You say, well, which one would I want? To me, it talks about the first step is, that's on the next page, on the top of page 4. You have to look at the fact that your contribution is based upon your wages. So you need to have wages or earned income in order to make a contribution to a plan. So that's the starting point. And also retirement plans, if you have employees, may require you to make contributions for other people in order for you to make a contribution. And I see business owners all the time, they have a 401k plan. Because the employees don't participate, they don't get the benefits of a 401k plan. They might as well be in a simple IRA or a simple 401k plan. So you work with your tax advisor. And what you would provide is, and that's what it talks about, you have your census data of your employees, their date of birth, their date of hire, and their annual wages. So that we can then take a look at, well, these are the different types of plans you could set up, and what is your cost going to be to what you got to cover for your employees. If you're just a single person in business, or you and your spouse are in the business together, then you really don't have to worry about that issue. The only question becomes then, and this is the question, how much money are you going to put away each year to put into a retirement plan? It requires cash. Okay? So I always look at clients, I see their tax returns all the time, and I'm going, well, you're not saving any money. I don't see any interest income or dividend income on your tax return. Can you afford to put money into a pension plan? And when someone is saying, yeah, they are saving, then we really want to maximize what they can put into the retirement plan. I'm not a strong advocate for Roth IRA. I know you hear about that all the time as a tax guy. There's some very good reasons why I don't believe you should be in a Roth IRA. I know that people are saying certain people it really makes sense for, but the average person, when they retire, their tax rate, I don't believe at all, is going to be higher than where they are today. Your income is higher because when you retire, you're going to have a hard time replacing the income you got today normally. Okay? So the average person is not going to be in a higher tax bracket when they retire. And if you're not in a higher tax bracket, you don't want to be in a Roth IRA. You want to be in a taxable account, whether it's a 401k or an IRA. And I can review that in a consultation if you want me to go over that with you in our follow-up meeting. But that's the conversation you should be having with your tax advisor, because that is the best tax shelter. I'll give you one example that people are not aware of. I don't see a lot written about this at all. But we do a lot of elder law Medicaid planning. Whenever you have a client that's older, they have IRA accounts. And if you are familiar with the cost of nursing home care, it's $5,000, $6,000, $7,000, $10,000 a month, depending upon your condition. What I advocate is that when you're older, you tap into your IRA, your pension plan. You can take the money out in order to fund your potential nursing home care. What happens if you do that? You have income of whatever it is, let's say it's $70,000 for the year, but you get a medical expense deduction on your personal tax return. The money comes out virtually tax-free. They just change the rules that your medical expenses are reduced by 10% of your income, so you get to deduct 90% of your medical expenses, or 80% of your medical expenses. You pay no taxes on that IRA distribution. And I say to people, would you rather have more money sitting in an IRA so that you have more money to pay for your nursing home care, that you don't have to rely upon maybe Medicaid, okay? Or would you rather, have less money in a Roth IRA and you get no tax deduction for it, you can take it out tax-free, but you really have less money to provide for yourself in your later years. Most people don't need to have that nest egg accumulated in a Roth IRA. They can take the money out tax-free. And so anyway, we're getting near the end of the topic here. We're going to have some questions on that, but one thing that we think we need to cover is how not to fear an IRS audit. And on page 23 of the tax guide, it talks about your travel, car, entertainment expenses, and talks about documentation required for those types of expenses. If you want to have an office and home, what kind of documentation you need for an office and home. Don't shy away from taking an office and home deduction. Okay, it's not a problem with the IRS if we got the right documentation. Okay, but I think that the thing I would share with you is when we go through an IRS audit, you have to have the receipts. If you have credit card statements and no receipts, it's not allowed. You need to have the receipt because they don't know from the credit card statement whether it's Home Depot or Staples or whatever it is. The hardware store, whether the purchase was for a personal item or a business item. They want to see the receipt. Okay? So that's important as a business owner. There's also a little known rule that business owners don't realize, that if they travel, as a business owner, you're not allowed to take the per diem expenses. We went through that with an IRS audit. And again, the IRS is getting sharper. They have new agents, they just follow it by the book. And there's a special rule, and I just found it the first time, and it was a guy that had all kinds of travel expenses, and they forced him to document every expense he had, and if he didn't have the expense, they disallowed it. Okay, and he ended up owing some taxes then. And the accountant had used the per diem amount, which really for years a lot of people didn't even know about the rule. A lot of CPAs didn't know about that rule. Okay, but that's what's happening. We're having a lot more audits. That's the other thing I'll share with you with the IRS. They've hired more people. We're having more audits than we've had. In the last 2 or 3 years, we've had more audits. That's all I can tell you. Usually it's business owners that have a Schedule C. Okay? And what they do, they looked at this individual, and he had a lot of expenses. He had a lot of travel expenses. That was the nature of his business. He traveled around the country. Okay? So I do recommend, one thing that I do in my business, I try to use a credit card for my business as much as I can. I have a business credit card and a personal credit card. It works. I just get the receipts. I just put them in an envelope. You just have to save them, then you just pull out the envelope if you're audited. You don't have to do anything with them. Just put them in an envelope, and then you got them. And keep them in. I have a box that has each tax year in it. That's where it's at. It's in my box. All my receipts. It's simple. It's very simple. You have a separate bank account for your business, and you go through the bank account, and again, you got cash in, cash out, and that's usually your profit for a lot of businesses. Okay. Health insurance reform. One of the last big areas there's another topic, a couple other topics too, but this is the big one. I mean, with the Obamacare rules that are kicking in, the exchanges you've heard about the last few months, and there's a lot of special rules that you need to be aware of. And it provides that if you are, beginning in 2014, if you're not insured, this is on page 5 of the book, the tax guide, that if you're not insured, then you will pay a penalty. Okay? So the tax penalty is one of the issues that people are saying, oh, gee whiz, well, I don't want to pay the tax penalty, but young people have already figured it out. I'll pay the tax penalty. And I think there's an interesting part about how that works, because when you sign up for an exchange, the open enrollment period is January 1 through March 31st. So for 2014, if you're young and say, I'm not going to get insurance, I'm going to pay the penalty. If anything happens to me, I'll just sign up, no problem, right? Because they say there's no pre-existing conditions anymore. They have nothing in the law that says you can't sign up. You got a little problem, though, okay? Because you only sign up between January and March. So this year, if anything happens April through December, you have no insurance coverage. You can sign up again January 1 of 2015. That's the risk that the individual's taken. Okay? But there is a risk. Okay? And heaven forbid, you don't know what's going to happen. So I don't know if it's really prudent for individuals to do that, but I mean, that is what a lot of people are talking about when they say, well, I'm not going to sign up for the insurance. I'll just pay the penalty. There's also a subsidy that would be provided so that when you sign up for the exchange, if you sign up for the exchange, you have to sign up for the exchange to qualify for this subsidy. And I have a handout that is separate in the book that covers a lot of different rules and everything. Go through it, but again, it's for you to use with your tax advisor or your insurance broker. So you have I'm trying to give you information. Knowledge is power. If you have a particular issue, I'm going to give you information to research it. Let's talk about the subsidy issue. And this is a problem that people are saying that people are going to get burned on this. And low-income people are going to get burned on this. When you sign up for the exchange, you have to estimate your income for 2014. Okay? Who knows how much they're going to work, particularly lower income jobs and everything else. And in fact, they might say, well, gee, I can just say I'm going to make $20,000 and I get this big subsidy, and hey, that sounds great. And they really don't understand the fact that what's going to happen. What are the consequences if they underestimate their income? If they underestimate their income, they get more of a subsidy. Okay? When 2014 is over, they file their tax return in 2015. Then the IRS, this is where the IRS comes in, that the Congress was upset about. The IRS is now charged with enforcing collection of recovering the subsidy if they underestimated, if they lowballed their income. And so that if their income is actually higher, it's in the system, they're going to say, well, your subsidy should have been X, you took Y, you owe us this amount of money. And that's the problem people are going to have. Now, a lot of people maybe, what percentage of the people really are going to get caught blindsided by that? How many people do you know out there that, I got to say, they don't understand what's going on with this exchange program. They don't understand what's going to happen in 2015. These are some of the flaws that they're talking about in the system of how this whole healthcare reform is going to work. Let's go to the next page. Well, this is good for some small business owners. That on page 20 it talks about that if you have fewer than 25 employees and pay at least 50% of the healthcare premiums, you can qualify for a tax credit up to 50% of the premiums paid by the company. So you kind of look at this handout. I have this, that's a separate handout. This is a letter we sent out. This has been around for 3 years, going back to 2010. Okay? But the example I give, because it talks about your credit's going to be 50%, but the example I have in the first paragraph of this letter is, if the company has 15 employees and their average wages are $35,000, they don't get a 50% credit. You know how much the credit is? 9%. This credit falls off the chart depending upon what the average wages of your employees are. I met with a new client yesterday that has opened up a cleaning service that are paying $10 an hour. They're going to fall right into this category. They're going to have people that 10 or fewer employees, their average wage is under $25,000, and they're going to be able to get a tax credit if they provide health insurance. And I talked to this person that could be an incentive to try to get good people to work for you, and maybe they'll work harder if you do provide their health insurance and you pay half of it. Okay? And I talked to that business owner about maybe you qualify for the targeted jobs credit. You go to Job and Family Services here in Northern Kentucky, and you find out people that are looking for a job and they need a job, and you could find some really good workers, and that you get a tax credit. Or you hire veterans that you can get a tax credit for hiring them. So you get a tax credit for hiring someone, and if you work through Job and Family Services, they may even have training programs available that they would help you pay to train your people that you're hiring if they need special skills in your particular business. So you can be really strategic as a business owner, and these programs are out there. You might as well use them because somebody is, and you're paying your taxes, and this is a way of having Uncle Sam help you in your business by helping you with your employees and helping, when you hire new people, that you can qualify for some of these programs. But there's another kicker that I got on going back to my outline on page 5. I referred to this handout that has a lot of information in it. But the tax credit is only available if beginning of this year in 2014, you can only get this tax credit if you obtain the health insurance coverage for the SHOP program. So businesses have to go through the SHOP program. That's all outlined there. It's basically the exchange for small businesses in order to qualify for this tax credit. And also the credit beginning this year is limited for only 2 consecutive years. So you're starting something, by the way, and see people, I'm not going to get the credit. So you started something with your employees. You better be careful because you're only going to get the credit maybe for 2 years. So you started something, you give them something, you think you're getting this credit, and it's only a 2-year credit. So you have to look at all sides of the equation, is what I'm trying to say. You have to understand the long-term consequences as well as the short-term benefits of trying to qualify for this small business tax credit. And those businesses that have 50 or more employees, you know that they postponed it for another year. We're still waiting for the regulations to figure out how those rules are going to apply. So that saga is going to continue on in 2014. We have no idea where this thing is going to end up. So it's hard to do any planning, and that's the thing that hurts businesses. But I can tell you there's a lot of businesses out there that are asking me the question, I'm going to raise this, should I have an independent contractor? Should they be an independent contractor, or should they be an employee? Because particularly businesses that are right around that 50 threshold, they're going to be subject to some other rules that are very stringent. We don't know what the regulations are, but there's a lot of penalties out there. For health insurance, you provide your employees. So you got a really big issue if you're a business owner, and that's what companies are looking at. Well, I'll just go and outsource my computer team. I'll outsource it. Independent contractors. I'll outsource this. I'll outsource that. Or I'm going to try to structure my business arrangements so that they really are an independent contractor. I'll give the example of the cleaning lady, her business from yesterday. I talked to her about, she actually has a company that she's cleaning the building for, that she's a subcontractor, and they've given her, they're going to give her a 1099 because she hires employees, she manages the employees, and she provides her own supplies for the employees, okay? So in her situation, she is an independent contractor for this other company. It was a great example. So I said to her, if you're going to hire somebody and you want them to be an independent contractor, what you would need to do then is do the same thing. They need to have maybe their own insurance. They provide their own supplies, and you tell them what they need to do, but you don't manage them. The yin and the yang. That's an issue that a business owner has from that perspective. So those are the issues that are going to come up now more and more, is the independent contractor issue. And then I got to put this caveat in there. If they are an employee and you don't withhold the payroll taxes, as a business owner, you have a significant risk. You are personally liable, not just the business, for payroll taxes that should have been withheld. I'm not talking about just the Social Security taxes. I'm talking about the federal income tax, the state income tax, the Social Security taxes that should have been withheld, and you're personally liable for that because the IRS is going to come down on you. And you're going to be in that situation. So it's territory that, yes, you can have an independent contractor agreement. I've done that with clients. But when they come in, it could be wage and hour, it could be unemployment, it could be workers' compensation. When you go into this field, what's going to happen is they're going to burn you when they get hurt on the job, and they're going to want workers' compensation coverage, and workers' comp is going to make an assessment as to whether they should have been an employee or not. And when you fire them or terminate them for cause, they're going to go to the unemployment office. Or they're going to go to the wage and hour. They've been working time and a half, and you haven't paid them time and a half. Because they're an independent contractor, they've been working 50 hours a week, and you didn't pay them time and a half. Wage and hour is going to come in the state of Kentucky at no charge. It's going to audit the business. And will penalize the business if they violated. If the state determines that they should have been an employee. And they pay not only do you owe them time and a half, you pay penalties to the state. And the employee gets to contact the state, and they do that work at no charge. They don't even have to hire an attorney. Yeah. So you just got to beware on the independent contractor issue. It really has a lot of landmines. Also want to comment on the new law that came in Kentucky July 1st. A lot of people don't know this. It's in the attachment on page 1011. It's the last in the back of this section here. There's of the outline on 1011. That beginning July 1, business owners who have not filed tax returns or owe unpaid taxes to the state. It could be individual taxes, business taxes, sales taxes, state withholding taxes. That you may have, the Kentucky may revoke your professional license, your driver's license, and your motor vehicle registration. I have a client that is a mortgage broker in Ohio. Ohio has the same thing. And she couldn't get her license, her mortgage broker license, because she had a problem with her taxes. And I'm trying to help her with her taxes. And she found it out a week before January 1st when she couldn't renew her license. I had a client that's documented in this letter. He closed his business in 2005. August of 2013, he gets a letter from the state of Kentucky. You owe $4,000 in personal property taxes for your business. And if you don't pay it, we're going to threaten to take away your driver's license, your motor vehicle registration. And for a business he closed 8 years ago. And oh, by the way, it was personal property taxes. There was no personal liability for that. And I knew that he didn't have personal liability. I knew it was wrong, but they sent him a notice. And if he hadn't called me and I didn't know what I was talking about and I could look at it and assess it, that there should not be any liability, I called collections and said, by the way, this is personal property tax, isn't it? Yes. Well, the business is closed. The business is liable for this, and my client is not. And they go, yeah, you're right. But we sent that notice out to everybody. And this went back, 2004, 2003, personal property taxes. That's what Kentucky did in August. To me, the message for business owners is you can't mess around with the state anymore. Many states have adopted this legislation. It gives them, you basically have to work out a payment plan with them. If you ignore them, they have some clout over you. So you are not in a very good position. So you do not want to get in a position of not paying your sales tax and your payroll withholding taxes to Kentucky or Ohio. That's the message. New law, and it's happening. It's very real. We had the lady come in frantically the last week of December trying to help her get the tax issues worked out with the IRS, that she had assessments pending and they would not renew her license. Because also she had Ohio taxes pending too. That was the other piece of it. That's why Ohio kicked in. She owed federal taxes, but then we also found out she didn't file Ohio taxes. So she owed Ohio taxes, and so they weren't going to renew her mortgage broker license. Okay? So I don't know if we have any questions. I want to open up some room for some questions. And I don't know if anybody's got anything in particular. We didn't have any note cards, but we got a few more minutes, and I do have some topics I'll be able to talk about. Yes, Tracy.
Just a quick question on the small business, the 25 employees or less, that health insurance credit. Do you just have to offer it to all employees, or do all employees have to take it?
Well, this is... Okay, to qualify for the credit, there's actually a computation that's made. Okay, and so you have to pay more than 50% of the health insurance premiums for more than 50% of your employees, if I'm not mistaken. It's 50%. Let me see. So you have to provide the the insurance for more than. I'm going. Think about that question here. What's that, Scott? Well, it has to do, when you look at your, let me try to find that answer real quick. And I think it applies to the people that only take it. Okay, there's somebody that's not in the plan. But the people that take it, if you pay more than 50% for the people that take it, you qualify for the credit. That's how it works out. Okay? Yes, Jim?
And that is, regarding her question, that is only for the people who go through Kentucky, their state plan, or their...
The Kentucky SHOP program. For the business owner, if you're going to claim the credit in 2014, you have to acquire the insurance through the SHOP exchange.
Okay, so it wouldn't be like through, just going straight through, like Anthem or something like that, getting in policy with Anthem?
No. I mean, that was a special rule they put in there effective 2014 for that tax credit. And I went through this with my business. I think that it would be good to give an example. This is on page 6 because I really, I didn't know if I'd have time, but I think it's an important example. The example is on 2C that, my business, I pay for the health insurance. And it was kind of interesting. When I had my renewal come up in October, they contacted me, Anthem, in October, and I had like I had less than a week to make a decision whether I wanted to renew my contract December 1st instead of April 1st, which I did. I only had a 12% increase, but it grandfathered my plan for another year, okay? So I'm paying for a family $1,500 pre-tax because you could do that for your employees. The employer went into the exchange and found out that they could acquire the same policy for $1,200 a month. So they could save $300. I'm going, wow, that's great, isn't it? Well, there's a special rule that kicked out in September that indicated that if the employee acquired the premium through the exchange, under no circumstances could an employer reimburse him on a pre-tax basis. So he loses the pre-tax dollars on this. Okay? The deduction is significantly. So basically what ends up happening is the employee was actually in a 25% bracket personally. And it's on page 6. The state, the city tax, the Medicare tax. He was in a 40% tax bracket. So the employee would have to earn $2,000 a month and pay $800 in taxes in order to have $1,200 after taxes. Where the employee thought that we would maybe be saving $300 a month, it would cost him $500 a month in taxes. Okay? So there's a special rule here. They got all these twists and turns. And one of the things that employees do, if a company, employees have the company do, is they try to pay for your premiums pre-tax. And they're slipping these rules in here to take it away. The regulation was very specific on health reimbursement arrangements, on cafeteria plans. They amended the statute, from that if you got the program through an exchange, you didn't qualify for a cafeteria plan, where you could do it on a pre-tax basis. And it was a September ruling, and I haven't seen anything written about this at all in my reading, I mean, there's just these landmines that are out there, okay? So I think that's another example that you really need to work with your tax advisor if you're providing health insurance for your employees, okay, and try to do it on a pre-tax basis. Yes, Keith?
As far as being audit ready, what is there's a rule of thumb about maybe 3 years worth of receipts. Does it matter what kind of company, or is that 3 years the number I just kind of came up with?
Well, no, the IRS has a 3-year statute of limitations going back. There's a 6-year statute of limitation if you underreported your income by more than 25%. That's your income. Okay, so that's why some people say 6 or 7 years, because you're into this, theoretically. But if you know that you're not underreporting your income and you have no fear, theoretically you only need 3 years. Okay, so I think that would be the rule of thumb from that perspective. And as far as keeping records, I think, it is important. I tell you, I have this problem right now with my bank. You do internet banking, you got to be very careful, because you got to get back canceled checks. It drives me crazy. I am getting copies of all my canceled checks in my business. If I had an IRS audit, guess what I'd have to do? Go back and get the copies of the canceled checks and pay what? So I'm doing that now in my business, and I actually thought that we could do it online, but then I just decided I'm not going to worry about having to go back in. I can't remember if there was a problem when I did it online that I just decided I'm going to have to pay someone to go back through all those checks, and my labor costs, it was only like $3 or something a month. I said, fine, I'm just going to pay the extra fee so that you give me all my copies of my checks with my bank statement. I don't want to mess around with it. It's done. I don't have to worry about it. I have my box for 2013. I have all my tax, it has all my bank statements in it, and all my bank statements have copies of canceled checks, for my business. Okay, yes.
Regarding your statement about the Roth, the tax saving plan, I'm 32 years old. To me, the power of the Roth is the tax-free growth over time. Even though my tax rate will be lower eventually once I'm retired, to me it's that growth over time that's tax-free. Would you still make that recommendation to somebody my age?
That's the scam of it. It's the way the government got people. They did the Roth years ago, and you do the analysis. What ends up happening, you think that, well, I'm going to be growing this money tax-free. But if you have more money growing tax-free, then you end up ahead of the game because you're in a lower tax bracket when you take it out. So if I did a spreadsheet, I just, for me, I needed to see it on paper. And I went out 30 years and I showed if I did the IRA or the pension plan, whatever the dollar amount was, and I had $10,000 accumulating over 30 years, or if I was let's say I'm in a 40% tax bracket, and I have $6,000 accumulating over, well, I'm going to have 60%. The Roth is going to have 60% of what that has, okay, in this example. If I'm only in a 25% tax bracket down the road, then I'm going to pay tax on, I'm going to have a bigger nest egg. Because when I take it out, I'm not going to pay 40 cents on the dollar. I'm only going to pay 25 cents on the dollar. So it doesn't matter the growth because they grow proportionally. It's an accountant's and analytical mind that has to kind of work through that analysis.
Is that still the case if you max the 17.5?
Mhm.
Can you still say that?
Yeah. Well, and I raised that question. Now, some people are just doom and gloom. They say, well, the IRS is going to when you retire, you're going to be in a 50% tax bracket. I don't think so. I mean, I'm not going to be that type of doom and gloom type of person to prey on people. That I just try to do what I think is, I can't believe that, and that's the other thing too, that if you accumulate $1 million, you're going to take out $30,000 or $40,000 or $50,000 a year or $60,000 a year. I hope we're not going to be in a 50% tax bracket when your income is. I'm talking about the average person, from that perspective. Now, if you have big income, I have some big income people. We did the Roth. Their families are always going to be in a higher tax bracket. We did the Roth conversion. Okay. I mean, yeah, there was all kinds of estate planning benefits you got that you don't have because the estate laws changed. We'll talk about that. But that was another thing that made that sizzle too, is you did the Roth conversion, you were paying the tax and you were saving estate taxes on it, on what you were paying out in income taxes. Okay. Well, I think it's 9 o'clock. It's time to break. We'll be available for questions during the break. We'll probably convene in 10 minutes. How's that? You have time for the restroom, and we'll see you back for succession planning. Thank you.